Welcome back to another episode of Malcolm on Money, where we decode some of the more complex financial topics folks tend to run into in an attempt to simplify it and make it as plain as possible. Today we're going to be talking about the 10% early withdrawal penalty the IRS typically assesses on distributions taken by anyone younger than 59 and a half, and how you might be able to avoid having to pay it. You may or may not be aware that the IRS allows you to withdraw funds from a traditional IRA without assessing the early withdrawal penalty if the withdrawal fits into a few exceptions. Let's review those quickly and get started. First, you have larger than expected medical expenses, which come up to more than 7.5% of your adjusted gross income for the year, and those expenses are not reimbursed under your health insurance plan. Then you can qualify for an exception. Also, you can use up to $10,000 from an IRA toward the purchase of your first home, penalty-free. What's also interesting about this one is that you can also use it to help a child or grandchild purchase a first home as well. Next up is education expenses. If you use IRA money to pay college tuition for yourself, a spouse, a child, or grandchild, then you are also eligible for an exception. Also, there's disability. Being totally and permanently disabled also qualifies you for the exception, as long as a medical doctor is willing to sign off that you are unable to engage in substantial gainful activity because of physical or mental impairment that is expected to be long-term. There's a few others, such as the birth of a child or adoption, as well as some nuanced rules around paying for health insurance premiums after you've been out of work for more than a year. In all of those cases, any of those exceptions apply. All you really have to do is explain yourself to the IRS when you send in your tax return for that year. But the situation I really want to dig into today is what happens if you're a person who retires early. Say you receive an early retirement package from your employer and you're 54, let's say, and you have no intentions of ever going back to work, but you also don't have enough in cash savings to bridge the gap until you're eligible to start taking your Social Security benefit. What then? Well, another one of the exceptions to this 10% early withdrawal penalty is something that the IRS refers to as a substantially equal periodic payment plan. However, most people just call it a 72T payment plan, which refers to Section 72T of the Internal Revenue Code, where you can find this rule. What it says is that if you are willing to commit to taking a specific dollar amount out of your IRA each year, no more, no less, for the longer of either 5 years or until you reach age 59 and a half, the IRS will waive the 10% early withdrawal penalty. Now, the reason this is great for someone who either plans to or has already retired early is that it allows you to cover that income gap that I mentioned in my example with the 54-year-old, while also avoiding giving away anything more to the IRS than you already have to. I won't go into exactly how the IRS calculates the amount you have to withdraw from the account each year, because there's several methods they allow you to choose from, and we'd be here all night doing the math. But the IRS does have a calculator on their website where you can go plug in your specific details, see what the outcome would be using all three calculation methods, and then choose the one that gives you the best payout for your individual circumstances. Okay, so a couple more things to be aware of with the 72T. In addition to taking only the exact payment from your IRA each year, you're not allowed to contribute to the IRA during the agreement either. Probably not a big deal since you're taking money out already anyway, but worth being aware. You're also prohibited from transferring or rolling money into or out of that IRA during this period. And this is perhaps the most important thing to know, if the arrangement is modified or stopped before the end of the required payment period, you lose the exception to the 10% early withdrawal penalty, and you'll owe the tax retroactively for each year the arrangement was in place, plus interest. The only way that rule doesn't exist is if you become disabled or pass away, or if the IRA is depleted due to investment losses. So again, you'll want to be sure that this solution works for your specific situation long term, and for those who it does, this can be a great option. Okay folks, that's it for today's episode. Hopefully you learned something new and feel compelled to like or subscribe or all that good stuff you're supposed to do on here. But more importantly, I hope you found this information valuable enough to share it with someone else you know. And if you'd like to receive more content like this directly into your inbox every week, then be sure to sign up for the Malcolm on Money newsletter at the address in the show notes below. And if you'd like to send us any comments, concerns, kudos, or ask a question, feel free to do so in an email at hello@malcolmethridge.com. Thank you for watching.